In this video, we're going to talk about the ATR stop, how to use average true range to judge your stop placement in day trading or swing trading. Stay tuned. Hey traders, a very warm welcome to you. So stop loss is so important, but so difficult to get right. Too tight, you get pinged out on noise. Too wide, you're taking unnecessary risk. Your account's never going to grow. Sure, we can stay in a trade forever if we have a wide enough stop, right? You can have a stop that's kind of the range of the whole year. You're going to be in that trade, but your position size is going to have to be so small, you're never going to make any money. Vice versa, we can all have a really tight position size, a really tight stop with a huge position size, but we're going to get stopped out loads and it's death by 1,000 cuts. So the sweet spot for a stop placement is wide enough that you're not getting pinged unnecessarily, but tight enough that you're not risking more than you need to. All right, so one thing I want to talk about in this video specifically is the average true range stop. Now, if you're not familiar with average true range, let's bring it up here. I've got a pound chart up, GBP USD, 1 day. Average true range is what I want. I'm going to stick it up and I'm going to change some parameters because this is just personal preference. Guys, it's, again, you can do whatever you want. Style, I like to have it yellow. Maybe this is a little bit superstitious anyway. And I'm going to stick it on a 10 just for this example. That's like another 2 weeks of trade, isn't it? 2 5-day batches of trade. So let's bring up something. Let's start off actually with the FTSE. Let's start off with the FTSE. You're probably familiar with the FTSE, and let's move on to a currency pair after that. So I'm on a daily chart here. I can see the average range of the FTSE. So using the ATR, there's a couple of ways that we do it. We'd use a percentage of that ATR depending on the time frame we're trading. So if we're swing trading over multiple days or weeks, then we're going to use a daily chart most likely. So we're going to look at the ATR and we're going to say, okay, the ATR at the moment is let's say 50. So how would we do that? We can now decide what to do. We can either have a fixed thing and say, okay, I want to use 50% of the ATR, so I'm going to use a 25 tick stop. Or if I'm looking for a longer move, I might use multiple times the ATR. So I might say, okay, the ATR is 50, but I want this for a year, so I'm going to use kind of 3 times the ATR. The point is, you're adjusting it based on your objectives in the trade, your time period of holding, and what you're trying to achieve from it. So if you're trying to achieve a long-term hold, you're going to have a bit of a wider range. But the beauty of it is that you're automatically allowing for volatility. If you go back and you look at, let me make sure I've got this. Let's say we go back to real volatile times where the ATR shot up to 150. Of course, if you're using a percentage of ATR, or whatever that is, whether you're using half the ATR or multiples of the ATR, you're actually adjusting for the volatility at the period in time. Now, what you can do, obviously, is when it's very volatile, you want to have a wider stop and you're going to reduce position size, obviously, to allow for that extreme volatility. And if you're still in the position as the volatility contracts, the ATR will contract with it. You can then, kind of tighten your stop up if you like. So it's a really good way of staying with the volatility, adjusting your position size to suit so you don't get pinged out. So you're not using ATR from way back multiple months ago when it was doing like a 50-60 tick range, or all of a sudden it's doing double triple that. You're basically reducing your stop size by a third effectively. You're going to get pinged out. It's not going to work for you. Similarly, if you're trading on a 5-minute chart, and let's go back to the currency example, Forex, let's do US dollar JPY. If you're using a 5-minute chart and you've got the ATR up and you're saying, okay, I want to trade intraday, I want to trade for kind of a multi 15-minute hour move or something, you might look at the 5-minute chart and you might say, okay, well, we're moving 5 pips in 5 minutes. Okay, I probably might want to do 3 times that ATR because I want to capture a multiple move, or I might go a little bit wider and I might say, okay, I want to go a 15-minute chart because I'm looking for an hour, which is going to be 4 bars, obviously. Where's that coming? Okay, we're swinging between, kind of 15 ticks, 5 ticks. All right, then I'm going to look at the highest ATR and maybe I'll use that, or maybe I'll use the midpoint and multiply it by 3. The point is, use different permutations you can use. You can use multiples of the ATR, as in many multiples of, or you can use a percentage of, i.e., a fraction of it. depending again on what your outcome is and what your objective is. If you're scalping, let's just put it into a scenario and say, okay, I don't know, we're buying a pullback and we're looking for a push to highs. This is a perfect one that's popped up here now. Pullback here, for example, we whatever we've done, the breakouts happened, we see a bit of an uptrend here, we want to buy a pullback on a 15-minute chart, we want to push to highs, we're looking for 50 tick moves, something like that in it, maybe looking for a breakthrough that 113 level, whenever we're watching this, whatever it may be. At that point in time, we're saying, okay, well, the ATR is 8 ticks, 8 pips, however we want to call it. So we do double check on that, we look on the range and we say, okay, well, the low 73, the high 80, yeah, so it's about that. Okay, if we're saying that 1 minute candle is about that range, then let's give ourselves 1.5 times that. Let's give ourselves, whatever that means, 12 pips range, because that's 12 pip stop, because that's giving us a little bit of room to breathe, and it's not too tight, it's going to be pinged out, it's not too wide, but it's unnecessary. So loads of flexibility there. Advantages that adjust with volatility as we start picking up in volatility. We start going up to sort of 12 ticks, 15 ticks, whatever it may be. You then will adjust the stop to suit and reduce your position size, so you're getting the same reflection on risk. And that's ATR for the stop. Comments below. Any thoughts on that? See you in the next one, guys. Take care. Bye bye.